Trading psychology is one of the most misunderstood trading concepts out there. It gets blown out of proportion and it doesn't have to be as complicated as everyone makes it seem. Believe me, I've been trading for 6 years. 3 of them I was unprofitable. For 2, I saw no results, and for 1 year I was break even. And I always thought that trading psychology was the one thing that was going to finally make me a profitable trader. But that couldn't be further from the truth. And so in this video, I want to talk about how we can simplify trading psychology to its core so you focus on what actually is making you an unprofitable trader. So if you're struggling with trading psychology, this video is for you. So first we have to understand what emotions are, because at the end of the day, trading psychology is simply what people mean when they are talking about the emotions that they feel during trading. And emotions at its core, they're simply the gap between reality minus expectation. So emotions equals reality minus expectations. And before we go deeper into how we can treat this as traders, I want to prove to you that emotions equals reality minus expectations. How do we know that this is true? Well, let's look at some examples. Some real life examples that everyone has gone through. One trading and one real life. Let's say that me and you are going on a dinner and we say, okay, at 8 p.m. we are at the restaurant. So your expectation is that I'm going to arrive at 8 p.m., right? But let's say that I arrive at 9 p.m. There's a discrepancy here of 1 hour. So your emotions are going to reflect what you believe this 1 hour difference means. And if someone is late to a dinner that I book more than 1 hour, I can already tell you that I'm going to have negative emotion. But how can this actually change? Well, what if 1 hour before the dinner, I tell you, hey, your name, I'm actually going to be 1 hour late because of this insert valid reason. So now your expectation, even though we booked for 8 p.m., your expectation already is that I'm going to arrive 1 hour late. So when in reality I arrive 1 hour late, your expectations and reality go in line, so therefore you're going to have no emotions. But how does this apply to trading? Right? I believe that every single person has gone through this. Has someone had arriving late and that made you very, very pissed. But you probably also went through someone telling you that they're going to be late and you had no problems. Now, the real question is, how can we apply this into trading? And this is where I think that this formula is absolutely key because it goes to the core of what trading psychology can be. So emotions, as we've said, equals reality minus expectation. So every single time that you have negative emotion, it simply means that reality and expectation didn't go hand in hand. And how does this apply mainly in trading? Every single time that you enter in a position, you're gonna say, yeah, well, the market hit a higher time frame PD array and it started moving bullish, so therefore I entered. We had this was in line with everything on my checklist, so therefore yep, so therefore I entered. So when the market proves you wrong, in no way, shape, or form did you ever think that this trade could be a loser. So your expectation automatically is the trade is going to be a winner because you literally checked everything off from your trading plan. And if you have a profitable trading plan, then this should lead into a profitable outcome. So your expectation is that this trade is going to be a winner because you checked everything off. And once it becomes a loser, this is where a lot of emotions come in. And we can tie this perfectly with what I mentioned of the example of arriving late. If you invited me, you booked, you told me at what time it is, all of your expectations is that I'm going to arrive on time. Yet, once that doesn't happen, this is when negative emotions come in. Now, how do we fix it? Emotions you cannot change, right? Emotions are the end result. Can you change reality? No, you cannot change reality, no matter how much you believe in the law of attraction. And I also believe in the law of attraction. The only thing that you can change is your expectations. And now, how can we do this? Well, everything that we've talked about so far is about expectations. And the goal is to change your expectations. If you are able to manage your expectations correctly, it doesn't matter the outcome of the trade that you take. You're always going to have a little bit of emotion, by the way. It doesn't matter the outcome because you already expected it. So reality and expectation are always going to be in line in case you follow this exact protocol that I'm going to talk about. Just letting you know that I'm going to be hosting a live training on the 20th of January where I'm going to be breaking down how you can get funded in the next 90 days, or if you've been funded before, how to start getting consistent payouts. That's the goal, show you the system that got $5.8 million in funding over the last 90 days and also that gets me consistent payouts. So sign up with the first link in the description and let's continue with the video. I call this the expectancy protocol. Now, what is the expectancy protocol? The expectancy protocol is simply what I call the idea of reducing expectations as much as possible to the worst case scenario. Because reality, the lowest it can go is matching your worst case scenario. So let's say that the market is moving, the market is at the higher time frame PD array, and it starts moving bullish. And I forecasted that if the market moves down towards the higher time frame PD array and that it then moves higher, that I will execute on this position and that I expect the market to come towards the final target. So as soon as I see everything playing out, so higher time frame PD array tapped, yes. Market structure shift, yes. Did I forecast this position? Yes. Do we have an order block? Yes. Do we have a fair value gap? Yes. Everything is pointing for this trade to be a winner. But this is where the expectancy protocol comes in. And the expectancy protocol is about answering one question, which is, why will this be a loss? That is the question that you need to answer. Every single time that you enter in a position, you're going to ask yourself, why is this position going to be a loss? And now you might say, Kimmel, there's no reason as to why this trade is going to be a loss. If there's no reason as to why this trade is going to be a loss, then why do you not have a 100% strike rate? There's always a reason as to why your trade can be a loss. For example, notice how on this level, I marked out the beginning. What if we come towards the 50% of this level? So I was manipulated and then we have the nice market structure shift and then we go. I just took a loss, but the market still reacted how I expected from the level that I expected. So the market can always go deeper into a level. Maybe there is a bigger level all the way down that the market can go all the way down to. And once again, I was just manipulated and the market is actually going to go into that deeper level before it moves up. So why is this trade going to be a loss is the most important question that you can ask yourself every single time you enter in a position. And keep in mind, it's not that you shouldn't trade just because there is a reason why the trade is going to be a loss, but more so the reason why you are doing this is because you want to create the balance in expectations of the trade. The trade has all of these reasons as to why it's going to be a win, but it also has a few reasons as to why it can be a loss. It doesn't mean it is going to be a loss. It simply means that it can be a loss. And you as a trader, you have to be able to manage this balance. And obviously, by the way, to be fair, as a trader, everything you want is that the reason why this trade is going to be a winner always outweighs the reason why this trade is going to be a loss, right? You don't really want to enter in a trade where there's so many reasons as to why there's going to be a loss and few reasons as to why this trade is going to be a winner. But I'm making this so you understand that by reducing expectations to the worst case scenario, your emotion is going to be as close to zero because you would already be expecting the worst case scenario. It's not that you know it's going to happen, it's that it's already in your mind. And if it's in your mind, if it happens, you will notice that it will trigger a smaller emotional reaction. And now, I want to finish by talking about what the worst case scenario is for the expectancy protocol. So let's say that I enter in a position. The market hits the higher time frame PD array. It gives me the market structure shift. I enter right here. My stop loss is down here and my take profit is up here for a 1 to 2 risk to reward. So as soon as I get triggered in, what is the worst case scenario in this particular position? The worst case scenario is that the trade becomes a loser, right? That is the worst case scenario. So once you enter in a position, you will ask yourself, why will this trade be a loser? And I want you to imagine all of the reasons as to why this trade is going to be a loser. Maybe you are getting faked out and the market is going lower before it goes higher. Maybe it just hit a 4-hour higher time frame level and this will actually pull back a little bit further. So as soon as you enter in a position, you ask yourself, why will this trade be a loser? But let's say that the market now starts moving bullish, right? And you manage your position to break even. I don't think that you should move your position to break even, by the way. Usually moving positions to break even, it's an emotional decision. I always manage my position protecting by 3 PD arrays, but that is a whole nother topic of a video, right? So let's say you manage your position to minus 0.1. If you manage your position to minus 0.1, what is the worst case scenario? Your worst case scenario right now is that the trade pulls all the way back towards minus 0.1, giving you the minus 0.1. But the thing is, you were already running 1-to-1 R, and you see that trade pulling back, and you're like, no, I can't believe it. I took the minus 0.1. I was running 1 R. I can't believe it. You thought that 1 R was yours. That 1 R is not yours until you lock it in. So you always have to think about the worst case scenario, because the market, until you lock in those profits, is not giving you anything. It's showing you what is going on, but it has not given you anything so far. So by thinking about the worst case scenario, I want you to think about what are all of the reasons why the trade is going to go from 1-to-1 R to minus 0.1. Because by thinking about that worst case scenario, your expectations are only in line with the worst reality possible, which is the market fully reverses. And this is where you go through the expectancy protocol over again. You think about, why will this trade pull all the way back to my worst case scenario? And then you will find, okay, maybe there is a swing high right here that the market tapped, or maybe it's an order block, or maybe it's a fair value gap. There's a reason as to why the market is going to pull back, right? You just need to find that reason, and you need to put that in your psyche. It's not that it's going to happen, it's that it could happen, and if it does and you're not ready for it, you will be emotional. And so you always plan for the worst case scenario. So let's say that the worst case scenario once again does not happen, and the market is already pretty close to take profit, and you have managed your position to break even now, right? Your position is at break even, the market is close to your take profit. What are you gonna do? Well, you're still going to plan for that worst case scenario. You're still gonna look for reasons as to why the trade is going to be a break even. And now maybe you don't accept that the trade is going to be a break even, but that simply means that you have to close the position. But through all that time, what you are doing is that emotion is always going to be close to zero, because your expectation is going to be the worst case scenario. So let's say that you expect the trade to be a minus 1 R, and if this trade is a minus 1 R, then literally this turns out to be 0. Let's say you expect this trade to be minus 0.1 R, and your reality is that this was minus 0.1 R, this is 0. So your emotion is going to be dictated by your expectations, not by reality. It's going to be by your expectations. So do the expectancy protocol every single time that you are trading, every single time that you enter in a position, every single time that you manage a position. If you do the expectancy protocol, the likelihood of you reducing your emotions and mastering trading psychology, it's going to go up by tenfold. And keep in mind, this is never going to be 0, right? We are humans, and whoever says, oh no, you have to be a robot to be a profitable trader, they're lying, because they're not robots themselves. And if someone says that you have to be a robot in order to become a profitable trader, they're very likely not a profitable trader themselves, right? And so the expectancy protocol is probably one of the most important things that you can do as a trader if you want to become profitable over the long term. And this is only tackling trading psychology. If there's anything else that you want me to talk about, then just let me know in the comments. But trading psychology doesn't have to be as complicated as you think. Trading psychology boils down into emotions equals reality minus expectation. Whoever says that this is not true simply doesn't understand trading psychology enough, and they've likely not done it for long enough. So that being said, hope you all enjoyed. I'll see you in the next one. Peace. If you want to get funded with the best prop firm, either futures or CFDs, check out Funded Next with code Kimmel. It always gives you the best discount, and YouTube thinks you want to watch this video next.